Today we are going to discuss important adjustments to understand properly, fully explained by Ramesh Kumar, Sukija Accounts Teachings. First is creditors include 500 which are no longer payable. Second is calculation of total capital. Third, adjustment of goodwill on the basis of goodwill paid by the newcoming partner. Fourth, when provision for bad debts is given but all debtors are good. Fifth, when assets and liabilities are to appear at old values, adjustment of capital. Number 1. Sometime it is given in the question that sum of rupees 500 included in creditor is no longer payable. This is decreased in liability and will be shown on the credit side of revaluation account. By creditors 500 and in the balance sheet creditors will get reduced with 500. Second, when the total capital of the new firm is to be determined on the basis of the capital introduced by the newcoming partner. In this, total capital of the new firm will be calculated by multiplying newcoming partner capital with denominator and divided with numerator, such as D is newcoming partner who pays 20,000 as his capital for 1/5 share. Now total capital would be 20,000 into 5 upon 1 is equal to 1 lakh. This will be divided in new profit sharing ratio of all the partners, or 80,000, that is 1 lakh minus 20,000 in old ratio to old partners. Now after making all the adjustment into old partners capital accounts, the capital accounts of the old partners will be closed as balance CD with the new capital as calculated with new adjustments. If credit side exceeds the debit side to cash or to current account, it will depend in the question whether they are to be paid back or their balance is to be transferred to their current account. And if the debit side is more, vice versa, this will affect the cash or current account accordingly. Journal entry can be designed accordingly. If credit side is more, revaluation account debit to cash, partners capital account debit to cash or current account. If debit side is more, by cash or by current account. Third, adjustment of goodwill on the basis of the share of newcoming partners. Sometimes it is given in the question that goodwill account is to be raised on the basis of the goodwill paid by the newcoming partner. Suppose C comes for 1/3 share and pays rupees 40,000 for capital and rupees 20,000 for his share of goodwill. And the firm decide to raise goodwill account in the books of the firm on the basis of the share of goodwill contributed by C. Now total goodwill will be 60,000, that is 20,000 into 3 upon 1. And goodwill account will be credited to all the partners including new in their new profit sharing ratio. Now balance sheet will show as goodwill at 60,000 and 60,000, that is capital and goodwill paid by the new coming partner will be added to cash account. Fourth, when provision for bad debts is appearing in the balance sheet and in the adjustment, it is given that debtors are all good. In that case, it would be deemed as increase of debtors or decrease in liability. In the valuation account on the credit side, it will be shown as either provision for bad debts or sundry debtors. Full value of debtors will be shown in the balance sheet. No subtraction from debtors as provision for bad debts, or on liability side any provision for bad debts will be shown. Fifth, when assets and liabilities are to appear in the new balance sheet at old values. In this case, first revaluation profit or loss will be transferred to old partners in their old profit sharing ratio, and then same amount of revaluation profit or loss will be debited to partners in their new ratio as under. If there is a revaluation profit, revaluation account debit to A's capital to B's capital to old partners in their old profit sharing ratio. Here we have assumed old profit sharing ratio as 3:2. Now one more entry will be passed. A's capital account debit 9,000, B's capital account debit 6,000, C's capital account debit 3,000, to revaluation 18,000. Being adjustment of revaluation amount in new ratio. If reverse is the case, that revaluation account is showing a loss, then in revaluation account on credit side by A's capital by B's capital in old ratio. Then on the debit side, same amount to A's capital to B's capital to C's capital. We will charge from their capital accounts. If you like this video, kindly like, share and subscribe it. Thank you very much.